the couple is not working and the other one runs a business, what you might do is distribute money equally. So you work your way through the tax brackets at the same time. If there's more children, adults, bits and pieces, then it becomes a lot more attractive from that perspective to be able to try and pay essentially less tax.
Yeah.
Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics such as investing, cash flow, budgeting, saving, passive income, debt management, and much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, here we are back again, back in the recording studio.
Andrew, we are back again. Favorite time of the week. We say it all the time. I feel like a bit of a broken record, but it is the truth.
All good podcasts, they start off with the same intro each and every single time.
This is true. And I must say, it just doesn't feel like, work or hard work or anything like that. It's just, we love it and bring a whole heap of value to our listeners and our viewers. And hopefully people get some stuff out of this one as well too.
Yeah, fingers crossed. It's always a nice juicy one. Bills, what are we talking about today?
Well, this one here, I think it's going to strike a chord, but how the rich stay rich. And a lot of this is going to focus on tax-efficient investment strategies. We all like to have a dig at rich people. Don't get me wrong. Hopefully we pull back the curtain a little bit and figure out what's going on and we can copy and emulate some of that.
Well, exactly right. I mean, we all strive to get to that point, right? Like that's usually why most people go towards financial advice, and rich is different for every single person. So whatever rich is for you, it's all about how to get there and how to stay there. So tax efficient investment strategy.
This is exactly right. And I was going to say, look, the answer to this question is just become a client of 360 Financial and you're going to get there.
Exactly right.
And that's probably it. We can turn the podcast off and that does it for this episode.
All right, Bills.
Well, again, good work. Andrew, where do we start this thing off? Where do the rich hide their riches?
Bills, look, I mean, the first one is really, it's not what you earn, it's what you keep. And so what I mean by that is, one, there's obviously the concept that we've banged on about time and time again, which is if you spend more than you earn, then you're always going to be going backwards. And even if you spend what you earn,
same thing.
Inflation is pulling you backwards. And so you look at it, one, from that perspective, and there's an age-old principle of making sure that your expenditure is, less than what your income is. And the same goes to, it doesn't matter how wealthy you are. And it doesn't matter how much income that you have coming in. So a lot of people just think, I got to earn more money. But the other aspect of it that this becomes really important is it's all about after-tax dollars. And it's all about the after-tax return that you're getting on your investment. So there's one is, it's not what you earn, it's what you keep when it comes to cash flow management, but also in your investment strategies. So if you're earning, for argument's sake, a 7% rate of return or a 10% rate of return, that 10% rate of return is not actually what you're making. Mm-hmm. You're making that rate of return and then you're paying tax on it. So are you paying tax on the entirety of that investment, both capital gains and income, because you're selling that investment? Are you paying tax in a 15% environment, e.g. through superannuation, or at 47% if you're on top marginal tax bracket? So what is your after-tax rate of return? What is your bottom figure after you take tax, expenses, all of that stuff into account? How much do you actually generate in return? Because differing tax brackets are going to mean that even if it's the same investment, it's going to perform very differently.
Yeah. And I guess, we'll talk about structures and things in a little bit, but you tend to find that as somebody's wealth increases, that the tax structure or the structures that they use in order to manage their tax affairs does get more complicated. So we're kind of giving a little bit away here, but in terms of thinking about, okay, what do the wealthy do differently? They're focusing on their tax. Obviously, you're making money, don't get me wrong, but they're also focusing on their tax position because, as an individual, if you're on the highest marginal tax rate in Australia, 47 cents off the top just disappears. It goes to the government. It goes into the ether. Who knows what they're doing with it? I don't think anybody knows. No, I'm just, that's a completely different rant altogether. But if you can look at that and go, okay, I've done all of the hard work in order to make money through a particular investment or business or investing or whatever it may be, if you can then look at what you have to relinquish from a taxation perspective, if you can lower that down, it's a huge difference. So getting into the right structure and getting the advice around what that looks like for you, because it's different for everybody, is probably the next thing that I want to call out. We've got different structures available in Australia. You can have investments in individual names, joint names, superannuation, companies, partnerships, trusts. We'll focus on trusts in a minute, but all of these different structures do different things, have different tax rates, have different rules around them. Getting your head around those and using the right one for what you're trying to achieve definitely makes sense. But in this particular instance, we're obviously talking about tax, because having the right structure versus having the wrong structure makes a significant difference from a taxation perspective.
Yeah, absolutely. And when you're looking at it, I mean, you really need to consider that as early as you can.
Yeah.
And this is sometimes a conundrum that you start to find yourself in, is that if you're still accumulating wealth and if you're still growing your wealth, you're almost in a position sometimes whereby you need to spend more initially in order for that to be right long term. And what I mean by that is, you could start down one particular route from personal circumstance side of things and say, you know what, my goals or my current circumstances are really simple, so I'm going to purchase assets in my own name. And then all of a sudden tax starts to become a bigger and bigger issue. You've accumulated more wealth, your income is higher. Now, all of a sudden, the implications to change that structure is that you need to sell that asset, incur a capital gain, cover the sell costs, move into another asset, which, depending on what type of asset it is, maybe it's a property, it incurs stamp duty, and you need to, move it into a different structure. It becomes a much higher barrier from a cost-benefit analysis, as opposed to, hey, I'm not necessarily making decisions on where I'm at right now. What I'm making decisions on are where I expect to get to at a future point in time.
Yeah, and that can be a difficult pill to swallow, because it does mean that you're spending additional money at the start for something that could cost you less, but in the long run, it's going to end up costing you more if you make the wrong decision. We've advocated for that for such a long period of time. And I think it's the same as anything. Maybe use a business analogy. If you were starting a business, you're going to want to get it right at the start. Spend the money, invest it, get the advice, do it properly, do it once, do it correctly. And that way you don't have to worry about that moving forward, because it can get very, very costly when you start to move things around, restructures and bits and pieces. One of the ones that I love from a taxation minimization strategy is using trusts, in particular a discretionary trust. Most wealthy families, I'd say this is a fair assumption to make, do use discretionary trusts, specifically their discretionary family trusts. And what they do is it allows them to be able to, with their discretion, choose that the assets that are coming through that trust or that are owned by that trust get distributed to different family members. So what you may do is you may be able to choose a family member who is on a lower tax bracket to be able to distribute money into that person. Now there's some stuff that sits around that. They need to be 18 and so on and so forth, have their own TFN and bits and pieces, but that's a really common strategy that we see, probably more so on a simplistic side between spouses. So you distribute income to, say, a non-working spouse. If one of the members of the couple is not working and the other one runs a business, what you might do is distribute money equally. So you work your way through the tax brackets at the same time. If there's more children, adults, bits and pieces, then it becomes a lot more attractive from that perspective, to be able to try and pay essentially less tax.
Yeah.
Legally.
You're right. I mean, look, you do need to balance it out, and this is why we're so big on getting advice, because from what you're saying, it sounds like, yep, trust is the way to go. You put your assets into a trust, but it's not quite that simple, because then you look at, other scenarios whereby maybe there's some negative gearing that's happening in a property and a trust can't distribute losses. It can only distribute profits. So you need to make sure that what you're doing is right for you and your circumstances. But yeah, absolutely. I mean, trust is one of the ways to be able to choose who you distribute income to, who you actually, force to pay the tax burden. And if someone is on a lower taxable income, it gives you the ability to distribute income to them as opposed to the higher income earner. Another one, which is really fantastic, but you don't necessarily satisfy the liquidity test, is superannuation.
Well, it's a trust structure, isn't it?
Exactly right. It's a trust. The only difference is that this trust comes with even more tax benefits in that, hey, if I put money into superannuation, it's not just me moving money from one asset to another or from one asset class to another. It's now all of a sudden I'm getting a tax deduction for giving my future self money.
Yep.
So there's benefits on putting money in. There's also the benefit of when it's earning an income, going back and hearkening to what we were talking at the start, and the investment that's growing even at the same rate of return, but the income is taxed at 15% as opposed to when you're earning it in your own personal name and maybe it's a 47%. You're getting that benefit of not just the tax benefits of being taxed at a lower rate, but the compounding effect of that. So someone, let's say in their 20s or in their 30s, that's got a, 35, 40-year horizon until they are able to access their superannuation, an additional contribution or a salary sacrifice into superannuation is not only going to benefit in that, hey, this is impacting my tax today and I'm generating a bit more of a rate of return today on the investments. It's the power of, hey, rather than paying 47% or even 30% on the earnings and everything that I'm making, I'm paying less tax as at day one, and that extra money is compounding for next year and the next year and the next year, and you compound that over a 30-year timeline, and the difference is massive.
Well, let's just use that as an example. I might just come up with some numbers top of my head, but let's just say you buy a property and you pay $500,000 for it, and then it's owned in your own name, and you end up selling it, 3 decades down the track for $2 million. So you've made a $1.5 million gain here. If that was in your personal name, that $1.5 million, you've held it for longer than 12 months, so that splits in half. So you'll pay $750,000 of capital gains tax at a tax rate, maximum tax rate of 47 cents in the dollar, 47%, right? I should have used the calculator to figure out what this number is, but let's say you pay $300,000 in tax. If you had that same investment inside superannuation, you pay zero.
Yep.
Pause for dramatic effect. Dun, dun, dun. So, obviously you've got the challenge with being able to access it. If it's a long-term investment, I guess what I just explained rings true, but you're still stuck inside the superannuation environment, right? So you can't touch that money until you meet a condition of release. Generally speaking, 65, regardless of your work status, or 60 onwards if your work status has ceased. But if you enter this with that type of long-term thinking in mind, I mean, 300 grand is, and that was just an example that I just used out of thin air.
And but it's property, right?
But it's absolutely huge. So imagine what that could look like further and further down the track with a little bit of planning. So, maybe that gives people a bit of an idea in terms of, hey, it may not necessarily be one particular structure. It could be a series of different strategies that we use to try and get an effective position on this, right across the board. Andrew, you're going to talk about timing and things like that a little bit later. We can talk about that, what it looks like. But obviously looking at superannuation, probably the most effective tax structure that we've got available in Australia. No doubt about it.
Absolutely. And look, while we're on it, I mean, timing is going to be a big issue. So if you are selling an asset, when do you actually dispose that asset? Mm-hmm. Maybe it's going to be different depending on your circumstances, but maybe it's at a point in time where one of or both of those people don't have an income. someone's recently set up a business, they don't have an income, you sell an asset during that point in time, and so you're working your way through the tax brackets rather than at a point in time where your income is higher. Maybe someone's on a maternity or paternity leave, their income is lower, and so you can dispose of an asset then. Maybe it's, are you, and not necessarily with property, because you rarely see people sell property within the first 12 months, but maybe when you're talking about shares or when you're talking about managed funds or other assets, holding it, making sure that you're holding it for longer than 12 months rather than buying and selling investments, because longer than 12 months, you're getting a 50% reduction in capital gains tax. Maybe it's, I'm going to sell an asset and then I'm going to salary sacrifice into superannuation so that you're not just selling the asset and paying the tax and that's lost. You're selling the asset, getting a tax deduction that's going to offset your future capital gain. And then you're also putting it into an environment where it's got some, one, compounding effect, but two, lower tax environment. But timing really matters. And we always say, don't try and time the market, and it's better to have a greater time in the market.
Yeah.
But when it comes to disposing of an asset, timing is crucially important. So if you are going to sell an asset for any particular reason, you really want to make sure that you're getting some good advice around that.
Yeah, and look, probably one of the most common examples that we see of that is that a couple have retired and they've got an investment property that they've held and they want to sell it. Considering, and if everything else works out okay, considering selling that in a year that you don't have employment income coming through. Yeah. Because that will reduce the taxable income that you've got in that particular year. You obviously get your CGT exemption. And then if it's owned by both parties, then you work through the capital gain gets worked through the tax brackets for both people.
So you retire in June.
Well, yeah.
And then you dispose of the asset in July, and then all of a sudden you're good.
Well, if that's your only income source for that particular year, but yeah, that's exactly right. And that could be a much more effective way of doing it than actually selling it in the same year of your income, but of the year that you finish working that you've got income in. But in saying that, I mean, all of the ducks need to line up in order to make that happen. But it's something that we see all of the time. And if you're looking at it from a retirement perspective and you've done the hard yards, you've set yourself up, it definitely makes sense to take that into consideration because it can be quite a big difference in terms of how much money you end up paying.
Absolutely.
From that perspective. And I don't know about you, but I don't want to give the taxation department any more money than I need to.
They take enough.
Well, back to the words of Kerry Packer, I don't think they can spend it as effectively as what I can, right? So, or something like that. I'm sure I've butchered it. Andrew, good debt versus bad debt. I mean, we've spoken about this on the podcast time and time again in relation to debt recycling strategies, but how does this tie in? How do the wealthy do this? And what's the secret when they're talking about good versus bad debt?
Yeah, I mean, look, when we're talking about good debt, really we're talking about investment debt. So something that you get a tax deduction on, versus bad debt, which is debt that you don't get any tax deduction on. So generally bad debt is, an owner-occupied mortgage or even credit card or personal loans or things that are debt, but it's not actually giving you any tax benefit as a result of it. So when we talk about, good debt versus bad debt, you want to move. General principle is you want to move all of your bad debt off your balance sheet and accumulate good debt. And then at that point in time, when you don't have any more bad debt and you've only got good debt, then the decision process is, okay, well, what do I do? Do I snowball more good debt into accumulating more assets and accelerate my wealth creation? Or do I go down the route of, okay, we're now at a point where we're reducing debt levels and we're actually working towards not having any debt at all, and then all of the income that comes into the household is investable money. Depending on your strategy, depending on your risk tolerance. I mean, that's the ideal scenario when you're at the stage of making that decision process. But the first step is, how do you actually convert and move all of your bad debt into good debt? There's the simple way, which most people think of, and that's pay down your family home, which is not a bad strategy. But at the end of the day, all that's doing is paying down your bad debt. It's not actually accumulating any assets. It's not delivering you any passive income. It's not giving you any tax benefits. So some of the other ways, and one of the other things that you can do is when you start talking about debt recycling strategies, and that's a podcast episode in itself, and we've done that a couple of times. So, hearkening back to those episodes, but debt recycling is another means to be able to convert your bad debt into good debt, and at the same time still be growing your investments in order to be able to deliver you a passive income, and utilize strategies like that in order to do multiple things as opposed to, just one vanilla thing that your money is going towards.
Yeah, and I want to use a real practical example that I think people will be really familiar with, but we've heard the old story about, you do your tax return, you go to your accountant and you complain about how much tax you're paying. So one of the strategies that an accountant suggests is potentially buying a property. So go and sign on a dotted line, go and take $600,000, $700,000, $800,000 as a mortgage, tighten the noose so you can look at your tax return, pat yourself on the back and go, look, I got a tax refund instead. So the idea is that you've then gone and created a whole heap of deductible debt. Yep. Risks aside for a minute, but essentially the interest that you pay on that debt is offset against the income that you're getting from the investment property. It reduces the amount of tax that you end up paying at the end of each year. So on paper, not on paper, you're losing money from an income perspective on that asset, which decreases the amount of tax that you have to pay. But over a decade, 2 decades, 3 decades, the asset value of that property has gone up quite significantly. So that's the way that people are utilizing debt in a good debt sense in order to manage their taxation affairs. So when you think about it from wealthy individuals that we're talking about, trying to get anything that they're doing from an investment perspective, trying to use the good debt analogy and good debt example, using that because it does then become tax deductible. There's a whole other conversation around risk and leverage and different bits and pieces and things like that. But it's really that good debt that they're using to be able to then try and massage their taxes down, so they're not paying as much money in tax, which brings us back to the first point around how much money do you keep, but then how much are you paying in tax above and beyond that as well too.
Yeah. Bills, I think one of the other ones is when you're starting to talk about some more tax efficient income streams. Now what we're talking about with this is, maybe you're investing in assets that deliver franking credits. Yes. Particularly when you're doing so in the superannuation environment, company tax rate at 30%, superannuation at 15%, or maybe you're in retirement, you're paying no tax. Or maybe it's, putting the money towards investment bonds, where it's capped at a corporate rate of 30%, and no capital gains if you hold it for longer than 10 years and don't breach the 125% contribution limits. Maybe it's in a tax-free retirement income stream, superannuation over the age of 60 if you're no longer working, or over the age of 65. But what I'm trying to talk about in all of this is the options are not as simple as, hey, let's just, buy an investment. What's the best performing investment? It's getting the structure, it's getting the income stream in the right environment, and bolting on the investments when they've got a specific purpose. So maybe an investment bond is right if you're, giving money to children and you're wanting to gift them a lump sum, and that's going to happen in X amount of time, and it's a defined period of time, and your contributions that are going to go in. Maybe you're liquidating investments and putting that towards superannuation because, when you initially started your investments, you're at a place whereby, okay, superannuation is still 10, 15 years away from accessing, the liquidity risk is too high, and so I want to make sure that I've got access to that money if I need it. But now that I'm 10 years down the line and superannuation is, now going to be something that I can access in the near term future, I'm going to, move assets from one environment to another. But making sure that your income streams and where you're delivering income is in the most efficient way possible so that you're not paying any excess tax.
Makes sense.
Jeff? And then also, above and beyond that, which is another thing that you need to consider, is what are the decisions that I can be making that's going to act as an accelerator? So what I mean by that is, I'm 60, I'm still working.
You look good for your age.
Well, thanks, Bills. I'm forever 39, just like you, although I haven't reached that age yet.
That's it.
Yeah, I'm 60. I'm still working. Hey, maybe I can take an income stream out of super, not pay tax, and put more money into super and get a tax deduction for it. Or I'm 65 and still working. Then I can accelerate that strategy because I've got no restrictions on how much I can pull in and pull out. But there is the ability to, in essence, shift money around, particularly when you're talking about superannuation, not impact your cash flow, not impact the assets that you have, not impact your liquidity, and in essence, pay less tax. So there's some really efficient strategies that just act as an accelerator and act as a boost in terms of how much money you get to keep that financial year.
And pay less tax, which we all love paying less tax. Andrew, probably the last thing that I want to touch on is just in terms of protecting wealth through, say, estate planning. One of the things that I tend to think about having, young children is thinking about in the event that something happened to me and thinking, okay, from call it a legacy perspective and saying, okay, touch wood, something happens to me and Samantha, the wealth that the family's created goes into a pool somewhere, gets invested, kids turn 18, happy birthday, go and spend like crazy type of thing. Obviously, that's a really fast way of destroying wealth that you've created. So one of the things that we tend to see with families, and it doesn't necessarily need to be wealthy families, I think it's more of a education piece rather than a cost piece, is basically going, okay, through the use of, say, something like a testamentary trust, you can control how and when the children get the money. And even if they do get the money or they get the potential income stream that comes off that money. So what that means is basically saying on the date of death, a trust gets created, going back to that magical word, for the benefit of the child, the beneficiary in this instance, that says, okay, when little Johnny is of a certain age, these are the parameters around when they can access their benefit.
So it's not just
It's not just here's an amount of money, like it could be when you turn 18, you're an adult.
Yep.
And then all of a sudden you go absolutely crazy because you don't have the maturity to deal with that level of money. It could be, hey, you're not going to get any money until you're 25. It's going to be an income stream. You can't touch the principal, or you can. You can structure it any particular way that you want, but it's just another mechanism using different structures that we were referring to about how do the wealthy continue to, make sure that the family and the legacy continues on.
Yeah. And I mean, I've even seen some clients whereby there's actual hurdles that an individual and a child will need to jump through in order to be able to access any of that money. Hey, you need a university degree. Once you meet, or once you get a university degree, then that gives you access to X amount of money. You need to, start a business and deliver this amount of turnover. And so you can, create incentives to be able to access wealth.
Mine's just going in different directions about the hoops that you can make them jump through
exactly
in order to get it.
And while you're on that as well, I mean, you talk about, passing wealth on to family, and superannuation. A lot of people don't realize that if you're making pre-tax contributions to super, which 99% of people are, the tax when that money gets passed to a non-tax dependent, i.e. an adult child, is taxed at 15% plus Medicare levy of 2%, so 17% tax. There are some crafty strategies around recontribution strategies of, pulling money out and putting it back in, where you can bring that tax to quite literally zero. So it's, again, when you're talking about estate planning, is making sure that there's no leakage, whether that leakage is in overspending and immaturity and access to funds, or whether that leakage is in excess tax that gets paid, making sure that you're across what the tax implications are going to be and how things are going to ultimately pan out is really important, because it can make a huge difference.
Andrew, there's a lot of complexity in everything that we spoke about. Yeah. A lot of benefit.
There was a lot in that one, actually.
Yeah, definitely a lot in that one. I think the message, like always, is get advice. Because if you get it right, it can make a significant difference to where this ends up. And especially, with a lot of the work that we do, we're talking about longer term stuff with people. And if you think about the compounding effect of assets and investments, you may be talking about a small amount of money today, but you go and then compound that over a significant period of time, and it can be Well, there you go. You took the words right out of my mouth. So, Andrew, I reckon that wraps it up for today. Thank you.
Thanks again, Bills. Thanks for another great episode. Thanks for tuning in. If you got some value out of that one, like, subscribe, share, and we look forward to catching you on the next podcast.
Thanks. Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au. The information in this podcast is general in nature and does not take into account your personal objectives, financial situation, or needs. It is not financial, legal, or tax advice and should not be relied upon as such. You should consider whether the information is appropriate to your circumstances and seek professional advice before acting on any of the information provided. Past performance is not a reliable indicator of future performance. This information is provided by Billy Amaritis and Andrew Nicolaou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of Acumen Financial Planning Proprietary Limited.